As most of you guys already know, for the first few years after graduating from college, I purchased a house and then I house hacked it. So I rented out the bedrooms to some good close friends, and if you're curious about how I did that, I'll make sure to link it just up above this video. Somewhere. So at one point during this, I had a friend of mine move out, and so I needed somebody to replace him. So I put an ad out on Craigslist, and pretty soon I found another guy to, take over his bedroom. Eventually, I was able to find a guy to come over and fill this vacant room. The guy's name was Kyle, and during the day he worked as a financial analyst. So naturally, we had money in common. So at the end of the day, if we weren't watching reruns of The Office on Netflix, chances are we would be talking about something regarding finances.
Bears eat beets. Oh. Bears beets Battlestar Galactica.
Bears do not. What is going on?
For the last year or two that we lived together, I remember Kyle always talking about something called the yield curve and all the different recession indicators that were associated with it. Just the other day, Kyle messaged me and said, guess what? The recession indicators have finally hit. So today we're talking about just that. We're talking about the yield curve, we're talking about recession indicators, we're talking about what it is and why so many people are freaking out about it. What is going on, guys? I'm Bryce with SaneSense.com, where as always we're talking about everything from personal finance to real estate investing. Today we're going to deviate a little bit from the normal topic, which is real estate, and we're going to talk about the yield curve. I'm going to do my best to try and explain what the yield curve is as simple as possible. So in layman's terms, the yield curve is essentially just a line graph that plots the average returns or yield for US Treasury bonds against differing lengths of time. So generally speaking, when long-term bonds are yielding more than short-term bonds, you see a very steady, gradual increase in the line. This line graph typically starts from the left and goes to the right and gradually increases. And if it increases, that's just a typical indicator that the US economy is healthy and it's growing steadily. This means that investors are, for the most part, optimistic about the economy's future. Now, when you see the yield line begin to flatten or even invert, that means that short-term bonds are now offering a higher return than long-term bonds. This means that investors can actually make higher returns on a short-term investment over a long-term investment. So say 3 months, you'll make more money over 3 years. And this is what people mean by the inverted yield curve. When this happens, this just means that investors, for the most part, are pessimistic about the outlook for the US market. Historically, this just means that a recession is right around the corner, and chances are that market prices are going to be significantly lower than they are currently. You see, for the most part, our culture, they pay attention to the stock market, but Wall Street, on the other hand, they pay attention to the bond market. The sad thing is, I don't know what people are freaking out about, because this has happened dozens of times over the past 100 years. For example, this happened in 1978, and then again in 1980, and yet again in 1988, then 2000, then 2006. Watching the yield curve invert is something that we're used to. It's not out of the ordinary at all. Looking back over the past recessions, we can see that typically speaking, whenever the yield curve inverts, we generally have anywhere from 6 to 18 months before we enter a recession. But on average, the recession generally hits about 14 months after the yield curve inverts. And then, once the recession actually hits, again, on average, the recession typically lasts about 18 months. Now, there's two things that I want to say about this before I go any further. One, chances are that the recession that we're about to enter is nothing at all like what happened in 2008, 2009. That was due to a major housing crisis, and there's been a lot of restrictions and a lot of regulation that have been put in place since that point so that that doesn't happen again. And number two is that the market always recovers. Not sometimes recovers, always recovers. Sometimes the recession may be a little bit longer, sometimes it may be a little bit shorter, but it will always recover given enough time. Within 1 to 2 years, the market will always recover to the same point that it was before the recession hit. And in most cases, it actually recovers higher than that point. So let's take a look at this on a graph. Each one of these highlighted gray areas that you see represents a recession. So let's take a look at December 1979. The recession officially hits. The S&P 500 is sitting right around $355. In June of 1980, the recession ends and the S&P 500 hits $372. The same thing happens again in July of 1981. The recession then ends in December of 1982 and breaks past the point previously hit before only 18 months later. So again, just to recap, whenever the yield curve inverts, this just means that investors are pessimistic on the outlook of the future US economy. That means people are taking their money out of more risky investments and moving them to something a little bit safer just because they don't know what's going to happen in the market. Now, the yield curve is not the problem itself, it's just the indicator of the problem. The other thing that I want to mention is this isn't a 100% sure bet. Historically speaking, when the yield curve does invert, that means that we are headed for a recession. But this hasn't always been the case. 90% of the time it's true, but there have been some false positives in history. I think we're headed for a recession. Now that being said, what do we do about it? And the answer to that is nothing. Wait, what? Nothing? No, nothing. Don't change a single thing. Don't be putting tinfoil on your heads. Don't be going out and building your doomsday bunker in the backyard. No, really, don't do anything. Don't change anything. Here's the thing, the market is out of our control. There's nothing we can do about it, and so we just have to let it do what it's gonna do. I want you to change your perception about what's happening. The sky isn't falling. In fact, this is actually a really good thing. By going into a recession, it actually means that we're going to adjust overinflated markets. And it means that everything is on sale. Stocks, real estate, you name it. You want to make sure that you keep investing and keep buying whatever it is that you invest in because you're now buying on a dip. Myself personally, I'm going to keep buying stocks, I'm going to keep buying real estate because I know that I'm getting everything on a really great deal right now, and years from now, it's going to be high again. The market's going to go up and I can sell it for a profit. If that's still not comforting enough and you're still not sure what to do, you don't really believe what I'm saying, then here's a couple things that you can do. If you want to make sure to protect yourself, make sure you pay off any high interest debt. Make sure that you have a sizable emergency fund. Make sure that you're not over leveraged. Make sure that you live well below your means, etc., etc. But you know what? This is all advice that I would give to somebody whether we were in a good economy or not. It doesn't matter. Yeah, these things can help you, but they're good things to do regardless. These are all things that you should do whether we have an impending recession or not. The worst thing that you can do is panic. When you invest with your emotions, you always invest and pull out at the wrong times. Always remember that investing is a long-term strategy, not a short-term strategy. We are always investing for the long haul. We don't really care what the markets are going to do today or tomorrow. Sometimes they're going to be up, sometimes they're going to be down. It doesn't matter because I'm still buying in regardless. That's it for this video, guys. Hopefully you learned something about the yield curve, and please don't panic because it doesn't mean anything. Everything's fine. The sky is not falling. If you learned something from this video, be sure to hit that like button because it really helps us out with the YouTube algorithm. And as always, subscribe and be sure to hit that bell so that you get notified each and every week when we upload new videos. Thanks for watching. We'll see you next week.